On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope you're all well. I wanted to talk today about share market returns because we all know that the average share market return is very, very good, but it's also important to remember that returns are rarely average. Let me dive in a little bit more and tell you what I mean by that. Shares have delivered very strong long term returns, and we'll look at the US share market today because it's the biggest market in the world and it's also got a very long history, which lends itself well to analysis. You can go back and look at 150 odd years of share market data. So it's great for analyzing long term data sets and looking at how returns have looked over time. I went back to 1900 and I just picked that because it was a nice round year, start of the 20th century. So it's 124 years ago if we include this year, which is almost done, not quite, but almost done. So between 1900 and today, US shares have returned 9.8% per annum, point to point. That's been the annual return over that period. That includes dividends, which is probably worth, I don't know, a couple of percent. So that is mostly capital growth, but also dividends. So we call that your total return because as share investors, we get returns in two ways. We get the dividends that come to us and we get the change in share price. And to be honest, we don't really care where returns come from. Returns are returns. So you add those both together and you get the total return. So 9.8% over those 124 years. And what that means is that as an investor, you've doubled your money about every 7.4 years. So many people will have heard the saying, which usually applies to residential property, it doubles every 10 years. That's true, it does. That equates to a return of about 6 or 7% per annum. With the US share market, you've got closer to 10%. So rather than doubling your money every 10 years, you're doubling it every 7 and a bit years. Not bad at all. Definitely not bad at all. That is a recipe for wealth generation. It's an excellent way to ensure that your capital grows more than inflation, which is really important because we need to do that to maintain our purchasing power. And in the US, inflation over that whole period has averaged 3% since 1900. It was low for a very long time, then it was very high in the 70s and in the 80s. Then it was very low again from 1990 basically to the start of the pandemic, and it's been high since then. But point to point, it's been 3% or so. However, what's really interesting, well, I think it's very interesting to consider, is the typical return in any calendar year. So I did that. I looked at that as well, and the results really surprised me. I thought this was really interesting. I was really happy to sort of write this report and record this episode to share these numbers with you, because even though we know that the average return since 1900 is basically 10%, just shy of that, you would think, with that in mind, that you can probably take a couple of percent either side. Let's call it 2% and say, well, between 8 and 12, you would assume that if the average return is 10%, a fair whack of your returns over those 124 years would fall into that return zone, right? Actually, no, not at all. In those 124 years, guess how many I found where the return was between 8 and 12%? Just four. Just four out of 124 years, only four, despite the average return over that entire period being very close to 10. Only 4 years where the return was between 8 and 12% in a calendar year. So I think that's amazing. Those 4 years, I could name them: 1912, 1993, 2004, and 2016. That's sort of an order of the lowest to highest or highest to lowest, I forget. But every other year outside of that range has, outside of those four, I should say, has been outside of that 8 to 12% range. And in many cases, by quite a wide margin. There have been 32 years where the market was down, 32 calendar years out of the 124. Of those 32 years, 7 times the market was down more than 10%, and another 8 times it was down more than 20%. So a fair handful of bad years. Predictably, the worst two of all were 1931. The US share market fell 39.3% that year, and 2008, and that was when the market slumped 37%. That was during the GFC. 1931, obviously, that's around the time of the Great Depression. You had the Roaring Twenties, which were a very buoyant period, and then the 1930s weren't. In 2008, obviously, that was the GFC. Again, came on the back of a very strong period for investment returns, economic growth, and so forth. And the GFC was a really difficult period for assets across the board. Certainly not all bad, though, because for the most part, the market has gone up. Of those 124 calendar years, 92 have been positive. So that's not a bad hit rate at all. That's a hit rate of about 74%. 74% of the time, 3 out of 4 times, the market has gone up. What's more interesting is that there were 46 years where the US share market rose more than 20%. So very good returns. This year's one of them. US shares at the moment are up about 20.5%. And that's sort of 11 months out of the 12 done. So this year has been a cracker year. The long-term average has been just shy of 10. We're up more than 20. So this year's been a good year. You wouldn't know it from what you read in the media and sort of the rhetoric out there, but it's been a fantastic year for investors. Anyway, 46 years where the US share market has risen more than 20%. That's more than a third of the time. That's more than a third of those 124 examples. It also includes 16 years where the US share market gained 30% or more, and 4 years where it rallied more than 40%. So there have been some fantastic years. And I guess the point, you wrap all that together, and the point I'm trying to make is that although the average share market return over the long term has been about 10%, returns are very rarely anywhere near that average. It's very unusual for returns to be even close to that average. So the variance is actually huge, and there's little consistency from one year to the next. And when you hear people, whether it's investors, whether it's wealth managers, fund managers, people like myself, when you hear people talking about the highly attractive returns that share markets have generated over the long term, they're not exaggerating. It's just that those returns don't come in a consistent manner. And as a share investor, you'll do very well over the long term, no question about it. But year in, year out, anything can happen. So even though we talk about the long-term returns being 9 or 10%, don't expect to invest and get 9 or 10%, because chances are you'll get something well above that, or maybe lower than that. But it's actually quite rare for returns to be in that zone. Don't be put off by that sort of variability. It's simply the price that you pay for those above average long-term returns. Remember some of the positives. 3 out of 4 years, the market's been up. That's not a bad hit rate. And it's been almost 6 times more likely to see a 20% plus rise than a 20% plus decline. We've had 46 times when the market's gone up more than 20%, and we've only seen 8 times since 1900 when it's gone down 20% or more. So the chances of seeing it being up strongly are much higher than it being down sharply. So I think the lesson is always the same. Stay the course, understand and accept that risk and return trade-off, or that volatility and return trade-off, you might say. Keep your eye on the long game. And if you can do that, history is very much on your side and you'll succeed as a share investor. Right, that's all for today. Hope that was useful. We'll talk again soon.